Hello, YouTube. Today we're going to be focusing on Jackson Hole, which is coming up in only 2 days, but it kicks off tomorrow. So, as we get closer to that time, which is going to be on Friday when Jerome Powell speaks, I am wondering who is wrong going into this event because someone is going to be really caught offside. Here we have the 10-year Treasury note up that we were talking about yesterday. So, yesterday we largely focused on the bear narrative or the bear case, and that's because we closed down. But today the market is closing up, snapping a 3-day losing streak. So, here the question is, do we have a cup and handle which is going to break bullish, or do we have a head and shoulders which is actually going to tell us that the rate of rate hikes is actually going to stop going as aggressive as before? Here we can note that Goldman Sachs is telling us that you are wrong if you think that the Fed is going to be hiking by 75 basis points as it sticks to its slowdown at Jackson Hole, Goldman Sachs says. I would much rather be in the camp of Goldman Sachs than of retail. And I say that because right now, 2 out of 3 retail traders of roughly 1,000 votes thinks that we're going to be down this week, which means that they think Jerome's going to be hawkish or is going to take stocks down. I don't know. When in doubt, I like to look at what the smart money is saying. These guys control Wall Street. And their notes here just tell us that they're expecting the Federal Reserve to stay dovish at its Jackson Hole gathering this week. Dovish is the key word. They're going to remain data dependent, and the Fed is unlikely to lift rates by 0.75 in September. It may go for smaller hikes instead, it said. Officials will likely push a slower pace of tightening and avoid a recession, its strategist said. This is really important because today we saw a repricing of the futures, again, now pricing in roughly 60.5% chance of a 75 basis point hike in September from about 45% on Tuesday. So it's not just retail, it's also institutions which are now betting that we're going to have a 75 basis point hike in September. This is important because the rate or the trajectory here from Goldman Sachs tells us that they've been dead accurate so far. Everything that they have called has been 100% accurate. They called for 25 in March, 50 in May, 75 in June and July, and now they're calling for 50 in September. I think they're calling for 50 and then 25 into the end of the year, which is where we're going to start to flatten out. We're going to get to a terminal rate by the end of 22 to 3.5%. That's how we get there. So by going from 75 to 50 to 25, that would catch the market a little bit offside, and we could definitely get that dovish reaction because people are betting that we're going to be getting a 75. A 50 would be a surprise now, and that would likely be interpreted as dovish. And I would note that when everyone's looking one way, it might be easier for us to go the other way. And what I'm basically talking about is team risk reward versus team probability. Team risk reward means that right now there is no side which has an unfair advantage. Team probability is that the objects in motion tend to stay in motion. And right now, as we note here, the S&P went up by 20%, went down by 5%, and it snapped its 3-day losing streak. The last time we had a 3-day losing streak goes back to, oh my goodness, that's right, where we carved up the bottom. We have 3 red days here where we close lower than we open with solid candles. And now we snapped that. We got 3 here in a row. We got a green one. The only other time we put in more than 3 was over here, as we noted yesterday. So the big question is, are we going to go up or are we going to go down? I don't know. And I know I've been saying that a lot lately, and that's just because at a certain point, it's better to react than it is to predict. So I prefer to react to what is going to happen between the green line and the red line than to try to predict where we're going to go. I know at what point I am wrong, and I know at what point I am correct. So let's go through and have a look at a few more things, and we're going to go forward here. So what's really important to keep in mind is that Jerome Powell looks at core PCE, and we're going to be getting this reading on Friday at 8:30 a.m. Right now, the projections are for 4.3 in 2022, 2.7 in 2023, and 2.3 in 2024. Does it really have to go to 4% if next year we're expecting we're going to be at 2.7? I don't think so. And that's why I think that he's going to lay out what Goldman Sachs said. So we can also note that Jerome said he wants to slow the economy, not crash the economy. And today we saw that housing bubble bursts get louder. July permits for house sales data show the worst since before the lockdowns. Look at all these big fat red bars. That is not good. The trend is clearly down. We are seeing the contraction. And what Jerome said is that we're not going to feel or see the rate hikes until later, which means that Why would they want to go super, super aggressive when right now their internal projections tell us that we're going to be at 4, basically 3, then right back to 2. I think they're more likely going to keep interest rates flat. They'll keep them higher for longer, and then they'll lower them later. Right now, the market is expecting that we're going to be going down, doing rate cuts in 2023. That's where I think Jerome is going to toe the line, but it's not going to be at Jackson Hole. I believe he's going to talk about that at the next FOMC meeting, which is going to be in September. Why? Because there's an asterisk here. The asterisk means that this is a meeting associated with the summary of economic projections. And if you remember what happened at the July meeting, Jerome kept pointing back and back and back to what? The SEP, the summary of economic projections. He's not going to be providing that on Friday. What will he be providing? He'll be providing a commentary. He'll be talking. That's it. It's the same thing as he did during the press conference in July. Look at the date here, July 27. Goldman Sachs is expecting that we're going to get the same as what we saw here on July 27. What happened? Oh, baby, that was the bottom. We went from 390 to 430, or a 10% rip. That was a beautiful rally. So again, we're already seeing that there's a slowdown. He doesn't want to crash the world. He wants to slow it down. And if you look here now, the bull case and the bear case, like I've mentioned for ever since the weekend where we say the stage is set, the stage is still set. I don't know who's going to win. If we fail to get a DXY and TNX breakout, that is one of the top things I am looking for. And today we saw a notable tick down in the dollar. Earlier in the day we were down. So after we saw those housing numbers come out, we ticked down here by roughly 0.5%. We did double top, so I'm not sure if this is going to actually be a double top here or if it's going to be a cup and handle where we're actually going to keep going higher. But the dollar did back off. That's notable. In terms of the bull case, all we have to do is just punch up from here, and we're going to probably be going up. Looking at our key dates, we talked about core PCE. Remember, this is the Fed's favorite inflation gauge. So they don't look at CPI. They look at PCE. Why? Because it fits the story they want to tell. They don't care about CPI because no one drives, no one eats. That is the story of the Fed. All they care about is the PCE. Tomorrow we might see some headlines out of Jackson Hole from other FOMC members, not Jerome. And then we also have GDP and initial jobless claims out tomorrow. So this is the most important data points of the week. It's 8:30 and 10 a.m. So it's time to preserve our mental capital and be prepared to react to the data. And the reason why is because if we look over here to, let me get back here to my SPY chart on the weekly, I believe that the next move is going to be 10%. So the 10% move is going to be either 10% down, or we go from roughly 412 back down here to about, I don't know, the lows of the year, or we're going to go up to 450. So if we go up to 450 or down to 390, we're roughly at the midpoint here. And what we want to ask ourselves is, do we want to make that hard penny or the easy dollar? I'm stealing this from Mark Minervini, which means that if there's going to be a 10% move, right, 10%, and S&P normally does not move more than 2% in one day. We could move 2% on Friday, but 2 out of 10 is only 20%, which means we can capture 80% of the upside or the downside after we see the reaction to what Jerome says at 10 a.m. on Friday. So for me, I am less concerned about trying to predict where we're going to go. I want to react. So I am not really particularly motivated to try to predict where we're going to go. Although I do have a thesis, I would rather react to the incoming data. So we're going to wrap up in a minute here. We're going to look at the charts, and I'm going to tell you exactly where we need to go to know we are right or we are wrong. So as of right now, we printed 411.39 on the weekly chart here. This is still technically an inverse head and shoulders, which means that the onus is still on the bears to not only make us go sideways because the momentum has been building up for the bulls, they have to make us close below 410. Closing below 410 and then confirming by getting below 407, which is our low of the month, means that that's pretty much lights out for the bulls. Jerome is going to be interpreted as being hawkish, and we're likely going to go down. On the flip side, if we're able to get back above 420.76 on a weekly closing basis, that is my psychology chart, and that is my base case right now, that we're going to go back up to 450. I am not smart enough to know what Jerome's going to say. I'm smart enough to know this is not a time for me to be in the market. I'm going to wait, I'm going to be reactive, and I'm going to watch and see what happens here. Another way of thinking of it is, again, looking back here to SPY and looking on the daily chart like we have been for a while. What do? We went up by 20 steps or 20% and then down by 5. and we bounced perfectly off the green line. We got the curl here. And if we do start going back up, I think the bears are going to be reluctant to believe it because they've been reluctant the whole time. So another thing I want to look at is where S&P closed and where our algorithm predicted we were going to go. I've been teasing this out very briefly, and I'm doing that because we're getting a lot closer to our relaunch. What I want to show you here is the S&P closing price was 413.6. Our predicted close here was 413.1. And we predicted that QQQ would close at 314.87. QQQ closed at 315.01. Why is that important? Because there was not really much doubt where we're going to close today for me. We're off by about 50 cents for SPY, or 0.1%, and we're within cents on QQQ. So this is also notable because when we look to the options chain, as I have been for the last couple of days here, what do we have? Well, 413 was also max pain. We note here, 414 down to 411, even 410. Man, it's busy. Hundreds of thousands of puts. And they also burnt this open interest. So what does that mean? Means they did their job. They burnt everything over here on the call side. So they burnt everything from, they burnt half of the 414 puts, and they burned every single one of these. They all got torched. Over here on the call side, by closing at 413.6, they were able to pay up the 413s, but they did not pay the 414s, which means we pretty much closed a max pain too. Option sellers are in control. Who's one of the biggest option sellers? Goldman Sachs. So what does that mean? They're playing their playbook and they're getting paid. Oh goodness. Another reason why we want to pay attention to this is because there is a divergence between what is happening with the flow. Right now, the flow on the week is bearish. We note that we have 1.7 puts bought for every call bought. And these are only for orders over $100,000 because, in my opinion, these are the only orders that really matter. So there's definitely a tilt, which is quite bearish here. When we look to the Friday chain for SPY, and we note that the bulls actually made a little bit more today than the bears, and option sellers were in control. What's here for Friday? Oh goodness, we got 419 and we got 415 call spread with what? With open interest. We got it here at 415 and 420, and it is larger than what we see on the put side. There is only one strike here which has about 100,000, but there is open interest. So although it is fairly deadlocked, I would still say that roughly 412, 413 is max pain as of right now for Friday. So what does that mean? It means the bulls appear to be more motivated, but I don't know who's going to actually take control. I think we're actually going to close around 420 on Friday. Why? That's what my psychology chart says. It doesn't mean I'm going all in or that it's a guarantee. It's just a prediction. But like I said, I would rather react than to predict. But I'm seeing more evidence here that the bulls might be a little bit better positioned than the bears. Last thing I just want to go through is looking at QQQ, because we looked at that yesterday too. And what's really important is that we're watching this relative low here, or 410.64 on SPY. If we now have a look at QQQ, where are we? So QQQ dragged us down and it lost that area. We're looking at roughly 318.52. So we're looking at roughly this low right here. And that's where we started the week off. So if we're able to reclaim this 318 area and get back inside the gap, I think we're going to shoot up to the red line and then continue higher. This is important because as we look at QQQ, we look here at our weekly chart, we note that, so we broke our falling wedge. We did a perfect back test. We're still trending up. We exited bear market territory or above 326. We entered a new bull market by being above 323. Then we fell back below. What are we forming? A cup and handle, right? We have a cup and handle forming inside of here. I don't know if it's going to be correct, but that's what's forming. It's not formed up. So with that said, if you want to watch more, I encourage you to watch the weekend deep dive, which I prepared over the weekend, which tells you that the stage is set and we have to be very mindful that this week is likely the most important week for the rest of the year. With that said, I want to thank you for watching, and I very much look forward to seeing you tomorrow. And if you want to tune in on Friday, we're going to go through all the psychology charts and more. Thank you for watching. Look forward to seeing you tomorrow.